Just a quick one on saving for your personal tax bill. So that's when you take money from the company at some point with dividends. You're very likely to have a personal tax bill associated with those dividends if you've taken any sort of money. People want to know, well, how do you plan for it? I mean, there's three main ways you can do that generally. One is rob it from the company when you need it, but that's absolutely fraught with danger, and I try to avoid it unless you're super successful and you don't really mind and you've always got profits there. The second one is what we call the 10-30 rule, and it isn't a rule, it's more of a provision, but you could set 10% of the money you draw aside up to the first 50k, and then of the second 50k, set 30% aside. It's not an exact science. In actual fact, that you'll be putting too much tax in the bottom 50 aside and not enough in the top. But generally, if you carry on doing this for a year, you should have a really good pot of money to be able to pay that personal tax bill when it comes. The third version of this is calculate how much tax you're actually going to pay based on an estimate and then put that aside throughout the year. Either way, try and avoid number one.